Glad to be with you, Bonnie.
You have a new book out, The Failure of Laissez Faire Capitalism and Economic Disillusion of the West, Towards a New Economics for a Full World. You have said that there are three bubbles in the U.S. economy. What are they?
Well, there's the bond market bubble, the stock market bubble, and the dollar bubble.
And could you describe those bubbles and why you characterize these aspects of the economy as bubbles?
Sure. The United States economy has two very serious problems for which there may be no solutions. One of them, of course, is the offshoring of jobs that's been going on for 15, maybe 20 years. It's deindustrialized the country, it's destroyed millions of middle-class manufacturing jobs and also millions of professional service jobs that used to be filled by university graduates. Now, so this has made the economy dead in the water. If people don't have employment that's providing rising incomes, there's no way a consumer economy can grow. And so the economy is dead. Now, that's not directly related to the bubbles. The bubble economy comes from the financial crisis, which was produced by the deregulation. We had about 25 years of deregulation, especially financial deregulation. The entire financial market was deregulated. Federal regulators were actually prevented from regulating over-the-counter derivatives. And so we had this massive unleashing of greed and debt leverage and fraud, which produced the financial crisis and major financial concentration, what they now say are banks too big to fail, that have to be kept alive by public subsidies. Now, the bubble relates to the insolvency of these monstrous banks. The values of the debt-related assets on the bank's books are so low that the banks are insolvent. And so the Federal Reserve, that's what the Federal Reserve policy of quantitative easing is directed toward, by purchasing $1 trillion of new debt every year, that is, by creating $1 trillion of new money to buy $1 trillion of debt, both newly issued debt by the U.S. Treasury and existing debt, such as mortgage-backed securities from the banks. The Federal Reserve has driven real interest rates negative, so that the rate of return one gets in interest is less than the rate of inflation. That means you have a negative real interest rate. Now, why do they do that? They do that because the lower interest rates, the higher the price of debt instruments. And so by driving the interest rate into negative territory, the Federal Reserve has raised the value of the debt-related instruments, derivative instruments on the bank's books. Well, you can see now why we would have a bond market bubble. You have massive issuance of debt by the U.S. Treasury, an annual operating deficit of over $1 trillion that's being monetized by money creation, so that the dollar is being created at a far higher rate than the demand for dollars. So what sense does it make to be purchasing bonds that pay negative rates of interest when the debt is exploding and the money supply is exploding? So that's just a bubble waiting to pop. Now let's move on to the stock market bubble. Where does that come from? That comes from the fact that all the money that the Federal Reserve is pouring into the banks is not being lent out to consumers. They're too indebted to borrow, and the banks are too busted to lend. If this money, if this $1 trillion new dollars every year was finding its way through the banking system into the economy, we would be experiencing very high rates of inflation. So what are the banks doing with the money? They are speculating in the stock market, mainly, I believe, in stock market futures. So in other words, if you bet on stocks in the future market, that causes prices in the market to rise. So the stock market bubble then is also directly related to the Fed's quantitative easing. The third bubble is the dollar. The dollar is a bubble because it's the world reserve currency. It's supposed to be a store of value, a means of transaction to settle international payments throughout the world. In other words, every country's balance of payments is settled in dollars. Commodities are priced in dollars. What's happening to this dollar standard? Well, we've already said the Federal Reserve is creating $1 trillion new dollars every year. There's no demand for $1 trillion new dollars every year. And yet we have vast amounts of dollar and dollar-denominated instruments in the hands of foreigners, foreign central banks, foreign investors. For example, foreigners own over 34% of the United States public debt. So foreigners are sitting on $5.5 trillion in U.S. Treasury bonds. In addition, they own many other dollar-denominated financial instruments and real assets. So they've got all of these dollar holdings, and they're watching the so-called superpower water down their holdings by creating $1 trillion new dollars in debt and new money every year. So the dollar is a huge bubble waiting to burst. Why hasn't it burst? Because there's no clear sign of an alternative currency. The euro is in trouble because first of the American derivatives that was sold to Europe, and now because of the sovereign debt crisis. So the euro is in trouble, so it's not serving as an alternative. The Chinese have not released their currency into world markets where it could take the role of a reserve currency. So there's really no other currency, but the dollar is being chipped away at gradually and gradually. We see these agreements between what they call the BRICS, Brazil, China, Russia, India, South Africa. These countries have now agreed to settle their trade with one another in their own currencies and not use the dollar. The Chinese and the Japanese are making a bilateral agreement to settle their balance of trade in their own currencies and not use the dollar. We see an Asian currency bloc forming that's moving away from the use of the dollar. And so all of these developments cause the demand for dollars in international markets to decline and dry up. And as they do, the price of the dollar, its exchange value, has to fall. Now, that's when the bubble pops. When the dollar falls, the Fed can no longer control interest rates by buying bonds, because everyone looks and they can see that if the value of the currency in which a financial instrument is denominated is falling, then the instrument itself must be falling. And so bond prices will collapse, which means interest rates will rise. And there'll be a massive wipeout of wealth in bonds and stocks. In fact, all dollar-denominated assets. So that is the scenario. That's the bubbles, where they came from, and that is the most likely ending. When the dollar goes, all the bubbles pop.
I have heard you say that the Fed is naked short-selling the precious metals market, gold, etc., which is in a bull market. What is naked short-selling, and why would our central bank be shorting gold or silver in the speculative paper market to suppress the price?
Well, if you're trying to control bond prices and have zero or actually negative real interest rates, and the currency in which these bonds are denominated is the dollar, and the dollar is rapidly losing value in relation to precious metals, as it's been doing for 10 years and was doing very rapidly in 2011 when the gold price hit $1,900 an ounce. This was an indication that the dollar really wasn't worth its exchange value. When you see it losing value so rapidly to gold and silver, then the whole question is, what is that bond really worth? And if it's not worth what it looks like in its fixed dollar price, then the interest rates are going to rise because the price will fall. So the Fed said, okay, we got to break up this attack in the precious metal market on the dollar. How can we do that? Well, of course, it has all the big banks as its agents because they're all totally dependent on the Fed in order to stay alive. If the Fed wasn't pumping all this money into them and driving up debt prices, they would all be insolvent. So the Fed simply has Goldman Sachs, J.P. Morgan, whoever, go in. There are two gold markets. One is the demand for the metal, people who actually want to possess it. And then there's the paper market for speculators, where people bet on the price. What's the price going to be next week, next month, whenever? And so it's like a casino, these paper speculative markets. So they go in there and they say, okay, we're going to sell $100 billion of paper shorts. We're going to short the gold market, 100 billion or whatever figure they decide. Now, when you short a market, you stop its rise, you can drive it down. And so they operate in the paper market in order to offset the constant rising demand in the market for physical possession. Now, how do we know they're doing that? Well, they haven't called me up to tell me. But when you have a bull market, as we've got in gold and silver for possession, you don't short bull markets, you ride them up. Who's ever heard of shorting a rising bull market in stocks? It's not what happens. You get wiped out. You short a bull market in stocks, unless you hit it right at the turning point. And so they use these paper shorts to cap the price of gold. They really don't want it going over 1,700, 1,750. And that is the way they offset the upward pressure on the price of gold and silver from people taking physical possession. More and more central banks are buying into gold. Everywhere they're lightening up on their dollars. It's not a major, massive move that would destabilize the system all at once, but it just sort of slowly chips away at it. So that's the reason the Federal Reserve sells naked shorts. A naked short, what that means is that they don't really have any gold to sell. And if whoever bought the paper instrument asked for payment in gold, they'd have a hard time. They'd have a hard time delivering it. But in the paper market, people are content with the profits on the paper transactions. And the paper gold market, they're not really interested in acquiring gold and silver. They're just speculating on price movements and price differences. So the Fed can sell what's called a naked short. A real short is you would borrow the gold somewhere, you would sell it, and you would bet that the price is going to fall, and so you can buy it back and repay the person you borrowed it from at a less price than you originally sold it for. So, but that's not what they're doing, because the paper market is not dependent on actual physical metal. It's just these paper transactions.
Now, Now, they can do this because why? They can just keep printing more dollars? And how long do you think they can keep this up?
I think they can keep this up until the dollar bubble pops. When the dollar bubble pops, they simply lose control because, as I said again, the value of all financial instruments that are denominated in dollars will fall when the value of the dollar itself falls. And when the value of a financial instrument falls, that means like the price of the bond falls, the other side of that is interest rate rises. So, and when the interest rate rises, the value of the debt instruments on the big banks' books falls, and their lack of solvency becomes clearer, and the whole crisis gets out of hand. So those are it's like a perfect storm. And so there's no real way out. How can the Fed get out of this? Can the Fed simply stop buying bonds? Well, if it does that, the interest rates are going to rise. That will hurt stock and bond markets and make the banks insolvent. So, but it might help the dollar if interest rates rise. But they can't let that happen. So what they're trying to do is to keep this going as long as they can. I mean, they're just sitting there day to day wondering, maybe Europe will go first. They say, maybe the sovereign debt blows up and that sends more money here, which keeps the process going.
Right, as long as they can sort of export the crisis, then they look better, right?
That's right. Plus, you see, if everybody is printing money, like the Japanese apparently are going now to print money. The European Central Bank is going to print money, though it's not clear how much money the Germans are going to let them print, but they're going to print. So if everybody's printing money, then they all get in a similar situation. In other words, we force this kind of policy on the rest of the world so that to prevent their currencies from rising to the dollar. So if everybody is printing, it's harder for the dollar bubble to pop. But the world is very unpredictable, and various things could happen. Suppose, for example, Hong Kong. The Hong Kong currency is coupled with the U.S. dollar. Suppose they decoupled it. Well, it would be a sign of a loss in confidence in the dollar. It would be a sign of China taking another big step into international monetary affairs. That could set off a crisis.
I'm speaking with economist and former Assistant Secretary of the Treasury for Economic Policy, Dr. Paul Craig Roberts. Today's show, The Bubble Economy. I'm Bonnie Faulkner. This is Guns and Butter.
There are a lot of things that could happen. For example, Cyprus. What they've done in Cyprus is to redefine a depositor in a bank. He's no longer a depositor. He is now said to be a lender, investor. He's lending to the bank, investing in the bank, and therefore his deposit is risk capital, and his risk capital is at risk. So if the bank has trouble, he has to expect to lose his deposit, so some share of his deposits. Well, this is a precedent. It redefines the situation for depositors throughout the Western world, throughout Europe, United States, Canada, Australia, New Zealand. All of a sudden, my money is not actually a deposit. It's an investment in the bank, and if the bank has trouble, I have to expect to lose my deposit. This could cause panic. Suppose the troubled Spanish and Italian economies. Suppose those people say, I wonder if they're going to do that to us. Is that how they're going to make us finance the bailout? And people withdraw from the banks. Well, the banks don't have enough money for everybody to withdraw because they have loans. And calling loans is very risky because the people usually can't pay them off all at once. And so all kinds of things can happen. There's now so much uncertainty caused by policymakers. You have to remember now, it was the policymakers who deregulated the financial system that allowed the financial crisis to happen. Without that deregulation, we would not have banks too big to fail. We would not have J.P. Morgan with derivative exposure equal to the world gross domestic product. The banks got nowhere near the capital to cover that kind of exposure. So you wouldn't have the situation that's developing in the EU, except for the policymakers. So the policymakers will, first of all, cover up for themselves. They'll try to save the banks as long as they can, and then it'll be somebody else's fault, not theirs. It's a very risky, dicey situation that we're in. And when you think about, where are your assets safe? As no one really knows.
Right, and you're referring to the so-called resolution of the Cyprus banking crisis, where they are going to expropriate a certain percentage of deposits over a certain amount. And do you feel then that there are ramifications of the Cyprus crisis beyond Cyprus?
Well, yes, because you see, Cyprus was considered a safe haven. And now they find out that they're not even considered depositors. If you're in the banks there, you are an investor. In other words, investors are not people who own, or not the people who own the shares of the banks. This is depositors. So to save the shareholders of the banks, they're going to take the money from the depositors. So this is theft, and they're just redefining it to make it look legal, but it's theft. They're stealing depositors' money, and they're doing it as part of the banking, as a solution to the banking crisis in the EU. Well, the banking crisis originated with the sovereign debt problems, and they're still there. Greece, Italy, Spain, Portugal. These countries can't service their debt. And so what they did in Greece was to make the people cover it by cutting their wages, cutting their Social Security pensions, cutting back social services, laying off government workers, and selling national assets, and turning that money over to the banks. Well, in Cyprus, the crisis is somewhat different, and they've decided to solve it by simply confiscating bank deposits. The original plan was to take some of every depositor. If you had less than 100,000 euros, they were going to take, I think, 6.5% of your deposits. If you had more than 100,000, they were going to take 9.9%. This caused a great social uproar, and we saw that the parliament wouldn't approve it. So they backed off, and now what they're doing is attacking large depositors in the two big banks. So people with 100,000 euros or more, they're going to take perhaps 40% of their deposits. But it's limited to two banks. So this then shifts the burden off the average person onto the rich. And it looks like most of these large depositors are from other countries, particularly Russia. So that sort of reduces the political fallout in Cyprus among the population, but it sends the message everywhere that, hey, look, it's not safe having your money in a bank for a new reason. On top of all the other reasons, now you've got to worry about they'll take your money in order to make sure the shareholders of the banks don't lose any money. So this is a very serious situation, and it could lead to runs on banks and collapses. And on the other hand, people may simply accept it. They may say, well, they're only going to do it to a few rich people. They're not going to do it to us. You can't predict the public response, but it is fraught with possibilities of panic.
When one of the bubbles pops, be it the dollar, the stock market, or the bond market, what is this going to look like in your view? And now, obviously, other countries are also printing money. Okay, the U.S. is not the only one. But do you think that Western countries are experiencing a turning point in history? Is this going to be a massive change?
Yes, I think the time of the West is past. And you'll see, I mean, Asia, rising Asia. The West has been very foolish and full of hubris and arrogance and has made all kinds of mistakes because it thought that somehow it was naturally forever the head of the world. And the most serious mistake was allowing the corporations to move the jobs offshore, because when you move the jobs offshore, you move also the careers, the incomes associated with the careers, the tax base associated with the careers, the gross domestic product associated with the careers, all that's offshore. And then when the products are brought back to be sold in American markets, they come in as imports. And so your trade balance falls apart. So that was a stupid mistake. It's hard to understand how any country could shoot itself in the head like that. And the whole time they pretended, oh, this is free trade, this is free trade. It's got nothing to do with free trade. It's labor arbitrage. It was, and the only beneficiaries was short-term profits. It pushed up. It meant when you save on your labor, it goes into your profits. So it's paid out in capital gains to shareholders and in mega million-dollar bonuses to executives. So they gained by wrecking the economy. Well, this was an amazing era. And I wrote about this for 10 years, and they just continue to do it. It's just because the people controlling the policy have an interest. Their short-term incomes are raised dramatically by this policy. And then the deregulation, it was obvious you should not deregulate the financial system. I mean, we've known that since the Great Depression. When Brooks Born tried to do her federally designated duty and regulate over-the-counter derivatives, she was prevented by the Secretary of Treasury, by the Chairman of the Federal Reserve, and by the Chairman of the Securities and Exchange Commission. They simply went to Congress and got it fixed, so she had to resign. She wasn't able to do a job, so they didn't regulate these derivatives, which have exploded in these massive financial crises. Why did they do this? They had some ideology. Markets are self-regulating. Well, we can see how self-regulating they are. We're in a major crisis and have been now since, December of 2007? How long ago was that? We've been in a crisis all these years.
Do you think that our central bank, the Fed, should be a government agency under the Treasury? Do you think that having a so-called private central bank is a big piece of the problem?
I don't know. There's a lot of people that say that. I think the problem comes not so much from how the central bank was set up, than from this notion that financial markets are self-regulating. This is a product of financial deregulation, not of how the Fed was set up. Now, I'm sure there are better and worse ways to have a central bank. And I'm sure there are good arguments about whether you should have one or not have one. And they're all worth exploring and talking about and debating. But for now, the real problem is they deregulated the financial system. They allowed they got rid of Glass-Steagall, which separated commercial banks from investment banks. So now the banks can use depositors' money to speculate in markets. This is absurdity. They removed the restrictions on debt leverage. So now financial institutions can leverage debt far beyond their risk capital. Well, this makes every bank vulnerable, the slightest disturbance. They took the limits off of speculators in terms of how big a position they're allowed in a market, so that speculators can now dominate commodity markets. These are just fabulous mistakes. It blows the mind that any group of policymakers could be so utterly stupid as to produce a situation like that. It's like dropping nuclear weapons on yourself. It's mindless. It's idiocy. So if they're going to behave that way, it hardly matters how the central bank is set up.
Oh, I've noticed, just as an aside, I've heard your kitty cats in the background. That is the cutest picture of you online holding your cats.
You see, Bunny, I was supposed to take them out at this time of day, and that's the female insisting that I stay to the contract. These cats came to me, they were born in my study 5 years ago, and I believe they're half bobcat.
Oh, wow.
I think the mother cat, she was 1 year old, a tabby, sweet little thing that I think she was a victim of a foreclosure. We found her wandering around pregnant and took her in. And her kittens have bobtails. They don't have a cat physique. They have powerful hindquarters. They sit much higher at the hip than at the shoulder. They have very long legs. The male cat is 50% bigger than a house cat. Both cats stand several inches taller than house cats. The female has tufts on the end of her ears. And they're wild. They're wild animals. They act like it. They accept me, of course. But so that's just my conclusion. That whatever they are, they're not. I've had cats for many, many years, and these are not cats. They're something else.
Oh, that's really neat.
But we have, and they're very communicative, and they've learned that they can talk to me, and so they are very insistent about we do things when we're supposed to, and so we got to wind this down because I got to go take them out because they're not going to get mad. Well, Bonnie, I think we'll have more, but I can't always predict it. But I think, in April we could look. This Cyprus thing could blow up in a big way. And also, you should download the software and read the book. And we should come on about the book. The book is it's astonishing. It'll astonish you. Yeah, let's do that, and let's keep our eye on Cyprus. I think we covered the current situation enough for now. And let's keep an eye on Cyprus and see what comes out of that. And if you can, the book's easy to read, it's not very long. And we can do a show on that. That'll help people get the nitty-gritty facts. You see, the financial press doesn't tell people things. The policymakers don't tell you. You really can't find out. They just tell you a bunch of lies. Oh, we have a recovery, or we're creating jobs, or we have low inflation, the economy is growing out. None of that's true. None of that's true. And so, as you'll see if you read this book.
Well, Dr. Roberts, I will read the book, and then maybe we can do an hour-long show on the book in April sometime. That would be terrific.
Yeah, that's a good idea, Bonnie.
Dr. Paul Craig Roberts, thank you.
Well, Bonnie, it's a pleasure to talk to you and to have intelligent questions, and I appreciate your interest.